Your credit score is vital to the type of mortgage you may qualify and can greatly impact the terms, such as the interest rate or fees, of the mortgage you qualify. According to the FTC, credit scoring is a system creditors use to help determine whether to give you credit. It may also be used to help decide the terms you are offered or the rate you will pay for the loan. Information about you and your credit experiences, like your bill paying history, the number and type of accounts you have, whether you pay your bills by the date they're due, collection accounts, outstanding debt, and the age of your accounts is collected from your credit report. Using a statistical program, creditors compare this information to the loan repayment history of consumers with similar profiles. For example, a credit scoring system awards points for each factor that helps predict who is most likely to repay a debt. A total number of points, a credit score, helps predict how creditworthy you are, how likely it is that you will repay a loan and make the payments when they're due. There are many different types of credit scores. Each of the three major credit repositories, TransUnion, Experian, and Equifax, each have their own credit scoring models. There are also many other types of educational credit scores which are available online. The two most commonly known credit score models come from FICO and Vantage, and each of those have several scoring models which can lead to confusion from consumers. When it comes to a mortgage, there is only one score that matters, and it's your FICO score. But if there are several different FICO models, how do you know which one is right for you? Well, according to myfico.com, the mortgage industry utilizes the following base FICO score versions: FICO Score 5 based on Equifax data, FICO Score 2 based on Experian data, and FICO Score 4 based on TransUnion data. Now, these versions may sometimes be referenced by other names as well, such as Equifax Beacon 5, Experian Fair Isaac Risk Model Version 2, or TransUnion FICO Risk Score 4. MyFICO.com also addresses the difference between a base FICO score and an industry-specific FICO score. Base FICO scores are designed to predict the likelihood of not paying as agreed in the future on any type of credit obligation. This could be a mortgage, a credit card, auto financing, a student loan, retail loan, personal finance company loan, sales finance loan, or more. Now, an industry-specific FICO score version, such as for a mortgage, they're designed to predict the likelihood of not paying as agreed in the future on a specific type of credit obligation, such as a mortgage, or such as an auto loan, or such as a credit card. They provide a lender with a refined prediction of risk for that particular type of credit. All creditors don't always report to all three credit bureaus, and because of this, your credit scores may differ. For example, a collector may only report to one bureau, which could cause that bureau to have a lower credit score. A mortgage lender is always going to use the middle of your three FICO scores to qualify your loan. If there are multiple borrowers on a loan, the lowest middle score of all borrowers is the one that's used for qualifying. To illustrate, assume that a borrower has the following three credit scores: TransUnion 645, Equifax 641, and Experian 780. In this example, the middle score is the TransUnion score of 645. Credit score calculations are based on many factors, not just whether bills are paid on time. In fact, according to myfico.com, FICO scores are calculated from many different pieces of credit data in your credit report. This data is grouped into these 5 categories. The percentages in this chart reflect how important each of these categories is in determining how your FICO scores are calculated. Your FICO scores consider both positive and negative information in your credit report. Late payments will lower your FICO scores, but establishing or re-establishing a good track record of making payments on time will raise your score. As the chart illustrates, 35% of your FICO score is based on a timely payment history. That's the same thing as saying that 65% of your credit score is based on things other than your payment history. There are many fallacies regarding credit scores, and several of them are addressed at myfico.com. One of the most common fallacies is that your credit score will drop if you apply for new credit. myfico.com says if it does, it probably won't drop much. If you apply for several credit cards within a short period of time, multiple requests for your credit report information will appear on your report. looking for new credit can equate with higher risk. But most credit scores are not affected by multiple inquiries from auto or mortgage lenders within a short period of time. Typically, these are treated as a single inquiry and will have little impact on the credit score. Accurate information regarding your FICO score, including education detailing how to improve or maximize your FICO score, can be found at myfico.com. Additionally, the FTC website offers important information including data on your rights, free annual reports, disputing inaccuracies, and much more, which can be found at this address.